the Basel III regulations said that the banks had to maintain a 4.5% reserve ratio. It's been zero for quite some time. So when you think about it, you aren't depositing money in this bank. You're giving them an unsecured loan that they're buying assets with. It's gone. They only have to keep 4.5 cents on the dollar in the bank. And so they're making loans. And after the crisis that we saw with the treasuries, and now we see an environment where, okay, maybe they're buying 10-year treasuries again, thinking, okay, we everything's okay. Rates are higher and it's maybe safe to buy it. And then what do they try to do? They try to lower the front end of the curve and the back end goes up, putting the bank's balance sheet in worse position again. These are problems that will not go away. These are problems that are, I think, systemic to the system. They won't go away. And part of me feels as though that's the intention here. I mean, you ask yourself, why would the Federal Reserve, in essence, goad all of the banks into loading up on treasuries and fueling the narrative of low interest rates forever, only to then raise them by 500 basis points, the fastest raise ever in the period of a year, creating these problems? It's absolutely insanity. But I do think that, the FDIC or the troubled bank list, so there's over 60 plus banks. There's probably a whole lot more than that are in real trouble. And I don't think the First National Bank of Lindsay was on that list. So anyways, yeah, I would just simply say the banks are not in good shape. If you have money in any bank account above the FDIC limit, I think it's insanity. And we were told this by Powell. There would be consolidations. This is what they want. They don't want 5,000 banks. They want a much smaller network of banks as we transition into central bank digital currencies, making it much easier to roll out modern monetary theory if we really go down that path. But this is just beginning, done again. If the Fed doesn't come in like they have before, everyone says, well, if you just would have left your money in the stock market after '08, and you would have been made whole. Yeah, well, the Fed added $9 trillion into the kitty to support, the bond market, to depress interest rates, to support the stock market, the real estate market. It's all artificial. It was all propped up by a Fed who came to the rescue. What would the world look like had they not done that? And I think that's what you need to ask yourself. And the question is, will they come to the rescue again this time? And if they do, what does the rest of the world think about holding our treasuries of any duration and our currency that is being inflated away? That's the question that has to be asked. So, you get to a point where you're so far in debt, you need, let me phrase it this way. We had the second biggest trade deficit in history last month, like 108 billion or something. Well, if that doesn't tell you how important it is for this country to be the world reserve currency, and how reliant we are on the rest of the world for imports, because we are reliant upon these people taking our dollar for their goods, and we are very reliant upon buying their goods because we've offshored so much of our production and manufacturing, and it's not sustainable. You end up compromising the world's desire to hold your currency and to hold your treasuries. That's when things start to really snowball. Now, we're not there yet, obviously, but these are the kind of actions that lead to an acceleration, lead to that moment where the world says, yeah, I don't want any more dollars, or I don't want your treasuries. And this is the rise of the BRICS and trading in local currencies, and why gold is doing what it's doing. So it's all one big dirty mess, but it's all connected together.
Andy Schectman states that the banking system is built on a fragile foundation, with Basel III regulations requiring banks to hold only 4.5% in reserves. This means that when you deposit money, you're essentially giving the bank an unsecured loan, which they use to buy assets or make loans. According to Schectman, these reserves are insufficient, leaving banks exposed to significant market risks. He argues that the Federal Reserve's rapid rate hikes, raising rates by 500 basis points in a single year, have exacerbated these vulnerabilities. After years of encouraging banks to load up on treasuries under the guise of low interest rates, the sudden reversal has left many institutions holding long-term debt at a loss. Schectman believes this is part of a deliberate push toward banking sector consolidation, which would simplify the eventual rollout of central bank digital currencies. Skeptical of the Fed's motives, Schectman points to the artificial nature of past market interventions where trillions of dollars in liquidity were injected to prop up asset prices. He warns that continued reliance on these strategies undermines the long-term value of the US dollar, especially as the world begins to shift away from it. The rise of BRICS nations and their preference for trading in local currencies further signals a decline in global demand for US treasuries and dollars. Schechtman emphasizes that gold is gaining prominence as a hedge against this fiat instability. He notes that central banks around the world are quietly stockpiling gold, recognizing its enduring value in an uncertain financial future. This trend, he argues, reflects a growing awareness of the systemic risks inherent in the current monetary system.
Well, I mean, I think there's a global need for a reliable store of value done again, and this is to facilitate trade and to safeguard excess capital. And I think the key is also without counterparty risk. I don't think the bonds can longer fully provide either. You see them, the Fed, lower rates. As we've talked about, there's all this talk of signaling victory over inflation, but it's not. They were 60+% away from their target at 2%. What it is raising the white flag. What it is massaging and manipulating the numbers that comprise the CPI out of the Bureau of Labor Statistics. And whether it be about unemployment or about inflation, the numbers that come out of there are suspect, to say the least. And what we are seeing, really, as far as I'm concerned, is the market's way of saying, at this point, buying any duration treasury. This is me talking. Let me just say this, that anyone who would buy any duration treasury, 10-year or longer, to me is crazy. I think they're uninvestable. The Fed will lie about inflation. Inflation will only get higher from here, especially by lowering the front end. And the market understands this. Gold understands this. This is why gold is roaring. This is why the bond market is selling off and rates are going higher. And of course, you can talk about the weaponization of the treasury market, which only adds fuel to that fire. But this is something that I would expect to see continue. You cannot expect to lower rates, go back to an inflationary policy, especially with asset prices at all-time highs, and not expect there to be consequences on the back end of the curve, where holding at these rates for any duration when inflation will erode and eat away at the purchasing power is insanity. And so I think that's the market saying just that. The concept of holding debt as an asset, I don't think is something that has a massive historical footprint. When you over-lever the debt the way that we have, and this debt that's very interest rate sensitive, and then rates start to go higher and the economy starts to slow, the maintaining of debt becomes very big deal. And if the debt isn't able to be serviced, and this is the whole concept of credit default swaps, where if you're trading with another partner who you don't quite trust, you take out an insurance policy against them and their ability to pay. And the insurance company's like, well, that's big money. Let's do it. And then boom, it blows up. And then real quick, the whole thing starts to spin out of control. So it's a problem. It's a problem that has to be dealt with. And this debt problem, it can't really be paid back. So the ironic thing about it is that most of it is owed to the American people, Medicare, Medicaid, Social Security, the government and military pensions. And so much of the money that's gone into treasuries has, as the foreigners have been selling them, we've been buying them chasing yield. So if you really want to get into the weeds and talk about resetting the system, we're resetting predominantly upon the American people. Only about 7 trillion is owed. That's a lot to the rest of the world, but to the American people, it's the majority. And what I was looking for earlier, by the way, Bank of America survey showed that 71% of financial advisors had a 0 to 1% allocation to gold. This was at the end of 2023, while only 27% had a 1 to 5% exposure. Shockingly, just 2% of advisors reported a 5 to 10% allocation. And, we're nowhere near the top in this bull market, as the American participation in the face of, positive real yields, if you believe the BLS and the BLS and the CPI, positive real yield, strong dollar, no American participation, nothing in terms of institutional money, and it still goes higher. And that's because of the central banks. They're the most well-informed traders in the world, and Wall Street will catch on.
In conclusion, Andy Schechtman's perspective underscores the growing need for a reliable store of value in an increasingly unstable financial system. As fiat currencies lose purchasing power and traditional assets like bonds become less dependable, gold and silver are emerging as essential safeguards against economic volatility. Central banks, recognizing the diminishing value of dollar-denominated assets, are diversifying their reserves into tangible stores of value like gold, signaling a shift away from dependence on unstable currencies. Schechtman highlights that the market's skepticism toward long-duration treasuries, coupled with inflationary pressures, makes these assets increasingly uninvestable. In contrast, precious metals like gold are seen as resilient and valuable, immune to the manipulations of interest rates and inflation figures. While most American investors still have low allocations to gold and silver, Schechtman warns that this represents a unique opportunity for those who recognize the inevitable devaluation of fiat currency and the risks of excessive debt. As central banks continue to stockpile gold and emerging markets seek to shield themselves from the instability of the dollar, individual investors would do well to consider the long-term value of precious metals. Schechtman's analysis paints a compelling picture of a future where tangible assets are likely to become more sought after, with significant price appreciation on the horizon for those who invest early. In this new era, gold and silver offer not just a hedge against inflation, but a secure means of wealth preservation amidst rising debt levels, geopolitical shifts, and currency devaluation. Understanding these trends and acting on them could provide a path to financial security in a world marked by increasing uncertainty. As the global economy shifts, those who prepare by reallocating to gold and silver stand to benefit from the inevitable revaluation of assets and the long-term erosion of trust in fiat currencies.